Hey guys, good afternoon. It's Denise Donahue, your mortgage nerd, and I am so excited that I've finally put this in recording because, of course, getting a mortgage loan, the most important thing that clients want to know is about interest rates. And my sole purpose and why I do what I do is to give my clients the tools and the education so that you guys are empowered and can make your own decisions and that we're completely transparent. My number one objective is to be able to put you guys in the strongest financial position. So I really think taking the next 5 to 10 minutes explaining the interest rate market, how it used to be and now it how is, and how I go about finding you not only the best interest rate, but of course knowing when to lock the interest rate in. So that's what we're going to go over today. If you guys have any questions, you're more than welcome to call or email me. I just wanted to get this recorded so that you guys can review it and listen to it over and over and over, because I know that's all you guys want to do on your nights and weekends. So let's get started. First and foremost, what I want to do is go over what is the DNA of your interest rate. How does a lender go about giving you, the client, the interest rate? So to go over that, basically between 1938 and 2009, there were two types of programs, so to speak. You had the conforming and you had subprime, or what's called non-conforming. And if you fit into the conforming bubble, almost everybody got a similar interest rate because there wasn't any kind of criteria, so to speak. If you qualified for that, that's the rate you got, and lenders could charge you whatever they wanted. Like, that's why you heard of premium yield spreads and all that kind of stuff. And then the subprime, well, that's just a whole nother story. That's kind of what got the housing market in the mess, and those were stated income type loans. People don't do those anymore, but the reason why is because our housing market crashed. And so in 2009, the CFPB and the government got involved, and they said, wait a minute, there are way too many mortgages that are going into default, mainly because of the subprime. So we're going to change the requirements. Lenders can no longer charge whatever they want to charge, and now there's going to be specific criteria around mortgages and interest rates and qualifying. So now, if you have a conventional loan, the interest rate is 100% dependent on what's called loan level pricing adjustments, or the LLPA. And this is the 30 types of adjustments, which is what you see here, that make up what's called your individual mortgage scorecard, or what I call your personal DNA for your interest rate. Everybody has a different scorecard. Your sister, your brother, your coworker that just bought a home or refinanced, their scorecard is going to look different than yours. So you can't compare your situation to their situation, but here's an overall snapshot of the 30 different things that the lenders look at. You'll notice that you'll see loan amount, the term, like the 30-year, 15-year, the purpose, whether it's a purchase or a refinance, but you'll see some things in here that are completely out of your control. Things like the property or the state of where the property is located, things like the county. So it's not just, this is how much money I'm putting down and here's my credit score, what kind of rate can you give me? There's no way for a mortgage banker to be able to answer that question. All the time I get phone calls. Hey Denise, my credit score is this. I'm thinking about buying a home in this price point. I'm going to put 20% down. What's my interest rate going to be? Well, now you guys having a little bit more knowledge around these adjustments, how can a lender or a mortgage banker accurately quote you an interest rate if they don't have all of those 30 things that make up your scorecard? What do you think they do? They're going to give you best case scenario. That's why you see on TV commercials. If you walk into your local bank, you're going to see an advertisement for mortgage rates, and you're going to see the best possible mortgage interest rate, along with a paragraph of fine print that says you have to be a unicorn to get such rate, or you have to pay an arm and a leg in closing costs. Now, it's in fine print. That's the stuff that nobody reads, but I want you to be educated on how this rate stuff works. I don't want you just to take people's word for it. I want you to be informed, because you don't want to spend an arm and a leg for the interest rate. So let's talk about a little bit of how I monitor the rate market, and kind of, let me back up a little bit. Let me go over how I shop to find you the best interest rate. So here you'll see how the money gets transferred, essentially, from the pool of investors to Fannie Mae and Freddie Mac to the banks, and then down to you. And so kind of what I want you to think about is all these lenders here, the Wells Fargos, the BB&Ts, and the banks, they sell hundreds, thousands of mortgages. They write thousands of mortgages every single month. And what they do is they get this money, the banks, from Fannie Mae and Freddie Mac. That's why Fannie and Freddie are the ones that write the rules. So what Fannie and Freddie does is they lend the money out to the banks and they charge a certain fee for it. And that fee is going to be a little bit higher than what Fannie and Freddie is paying to basically borrow the money from the pool of investors. So here's how it kind of works. If you think of a mortgage as one jelly bean, and a jar of 100 jelly beans is a mortgage-backed security, okay? It's an entire jar. It's got, let's just say, 100 of jelly beans in it. What Fannie and Freddie does is they sell this to the pool of investors at a certain rate. So the investors give money, lots of money, to Fannie and Freddie, and they say, we'll buy this jar of jelly beans from you at X amount, and you're gonna have to pay us that money back plus interest of 4%. So, excuse me, sorry about that. So if Fannie and Freddie are paying 4%, then they're gonna have to add a certain percentage to the banks so that they make their money, right? Because they're not gonna lend the money at the same rate that they're borrowing it. And then the banks do the same thing to you, the homeowner. And that's this fee here. So if we kind of follow it, you see that it's costing them 4%. Let's assume that Fannie and Freddie are adding a 0.25 to the banks, and then the banks add a 0.25 to you, which gives you your interest rate of 4.5%, let's just say. Now this rate here, where does that come from? That comes based off of your individual mortgage scorecard or your LLPA, those adjustments that we just looked at. So what I do as your mortgage banker is I shop to see, based off of your mortgage scorecard and the current bond market, who's going to give us the lowest servicing fee. Because I already know what Fannie Mae and Freddie Mac are lending. That's public information. That's how I have the ability to shop all the lenders, whereas if you just walked into an individual bank like Wells Fargo or Chase, sure, you might be a member with them and you might have all your money with them, but at the end of the day, they're going to only offer you what their going rates are. I used to work for the big bank, I can tell you, I know. So anyways, that's just half the battle. Finding the bank that's going to give us the lowest interest rate is just part of the equation. What's most important is that you hire a mortgage banker that knows how to monitor the bond market, those treasury bonds, those mortgage-backed securities, the jar of those jelly beans, you need to follow the bond market as close as a stockbroker follows the stock market. It's super important. There's 3 major economic reasons that causes interest rates to go up and down. Here's what they are: the GDP, unemployment rates, and inflation. Okay? So when any of those 3 factors are doing good, it causes mortgage interest rates to go up. Yes, it's kind of weird. When there's good economic news, it causes interest rates to go up. Now, if the news is bad, for example, if inflation report came out and it was worse than what we were expecting, it actually causes interest rates, mortgage rates to go down. The reason for that is because the mortgage interest rates have a negative relationship with the treasury bonds. So when you're getting a mortgage, yes, you want the U.S. economy to be doing bad, essentially. But it's important that your mortgage banker follows the bond market and knows what our government is doing and what meetings they're having throughout the week so that we can properly forecast what interest rates are going to be doing. So here's a little bit of a screenshot about what I look at and what I pay a lot of money to do when monitoring the market. This is a report that comes out every Sunday from Larry Baer, and this is what tells me Monday through Friday what's going on with our government and what they're meeting about. So if I see something like they're meeting about the newest inflation report, then this is going to be the report that tells me, it gives me a probability on this is going to be good news or bad news so that we can hedge the market. This report here the weekly mortgage interest rate report. This is from Fannie Mae and Freddie Mac. This comes out every Thursday, so it's public information. I can see what Fannie and Freddie are lending at and what their rates are. You can too. It's public. It's every Thursday. Call me or email me if you ever want to see this. It comes out at about 11 o'clock Central Time every single Thursday. Then this rate watch, this is what I get on my phone. I get text alerts. This is what I use to monitor the interest rates daily. So in one single day, like what you can see here, the interest rates do go up and down, just like the stock market does. So again, it's important to know, should we lock the interest rate in the morning or in the afternoon? What's going to give me the lowest rate? That's what I do as a true certified mortgage planner, is I give you my professional opinion on when to lock the rate in. So this next screen, this is my favorite screen. This is what kind of articulates knowing and having a mortgage banker that can properly advise you. So if you take a look at this, this shows you that what the interest rates did in a 60-day time period. So you'll see from May 1st, 2013 to July 1st, 2013, again, just 60 days of a snapshot. The interest rates went from 3.375 up to 4.875. It moved an entire 1.5 percentage points in those 60 days. Jump over to this one. This is a 30-day, back in September 2014 to October. Interest rates dropped entire full percentage points. So this means if you went under contract on this time period here and your mortgage banker told you to lock the interest rate in, that's going to be a very sad day, because that mortgage banker did not advise you properly, because all the reports would be indicating that interest rates are going to be dropping. And so this is your interest rate today. By the time you went to close, you could have gotten a full percentage point better rate. That is sad. Here is just a snapshot of what it did just in one day. This went from 4.25 down to 3.75 and back up to 4.25. So here's when you would have wanted to lock the interest rate in on that day. That's why it's so important. And I asked the question, do you want the lowest rate today or by the time you close? Because when you close, that's the interest rate that you're stuck with. And then lastly, this chart goes over, it answers the question, if you lowered your rate by 0.25%, okay, that's a quarter of a full percentage point. How much do you think that would lower your monthly payment? And the reason why this is so important is because many people think that a quarter of a point difference in interest rate is going to equal to hundreds of dollars a month on your mortgage payment. It's actually not the case. But this is a good example of something that we will provide to you once we lock your interest rate in. But let's go through this exercise real quick. Here you'll see all the interest rates. Let's say it's 4.375 to 4.2, 4.1, and 4%. You'll notice here in red that the 4.375 is actually going to give you a credit towards your closing costs. Many people don't know that this is the option. If you're working with a builder, this is what they call an incentive or a lender credit. You're actually entitled to up to 3% of your closing costs being covered, but there's no such thing as a free lunch, remember? So it's just built into the rate. It's what we call negative points. The next best rate of 4.25 is a true par rate. It means it's zero. It doesn't cost you anything to get, and it doesn't give you a credit. The next best rate of 4.125 is going to cost you $15.63, and then again the next best rate of 20 is going to cost you $21.88. So let's answer the question. If you were looking at a 4.25% interest rate and that didn't cost you anything, and then I showed you this chart and I said, but you could get a 4% rate, so a quarter of a point better, which is what we're talking about, but it's going to cost you $2,188. Let's just assume you had the money in the bank to pay it. Does it make sense to do? I mean, it gives you good bragging rights because you're getting a better interest rate, but financially, does it make sense to do? Well, the only way to answer that question is to look at what the monthly difference is on your payment and calculate a break even. So if you look at the payment difference of $1,229 and $1191, that's going to save you $38 a month. So you take this $21.88, you divide it by $38 a month, and it gives you a break even of 115 months. So what that means is that you would have